Hello, traders. Gary Wagner here. It is Friday. Happy Aloha Friday, as we say on the island. First day of October 2021, and this is the daily report for gold and silver, our weekend review. This weekend review will differ from most of our weekend reviews and daily reports in that studying the long-term charts, specifically the lead up to the record high in mid-2011, which occurred as a direct result of quantitative easing, and then the multi-year sell-off that followed, the rally that ensued. I looked at this particular sell-off and tried to compare it to what we witnessed back when gold traded to $1,920 and then moved down to a low of about $1,040 at the end of 2015-16. I will present a hypothesis and an assumption and back that up with chart work that indicates that we are most likely in a long-term multi-year cycle, which we will see a continuation of pressure on gold pricing, and it could take it dramatically lower. I hope you enjoy the show. Gold futures strong upside move yesterday, followed by a higher close today. Definitely stopped the cycle of lower closes on a weekly chart, which has occurred for the last 3 consecutive weeks. Today, gold gained $3.20, 0.18%, and finished at $1,760.20. Trading in silver resulted in a strong continuation of yesterday's upside move, with net gains of approximately 50 cents, taking the most active December contract to $22.54.5. It was buying that was the major contributor to the price increase today in gold. Unlike this first chart is a weekly chart of gold futures. Today's action, coupled with yesterday's strong move, clearly turned a candlestick that was red prior to that up until Wednesday and stopped this consecutive weekly cycle of lower highs, lower lows, and lower closes. While this week did have a lower low and a lower high, it did close higher when compared to the open on Monday. During the introduction to today's weekend review, we asked the question whether or not this recent move this week can be regarded as a key reversal. In other words, a bottom has been found and we'll see higher pricing, or is this just a upside move that will be followed by a further price decline? And really, to answer that question, we've talked about the fundamentals that are in play, Federal Reserve and the debt ceiling. But what I want to talk about today is looking at the big picture. And what we are looking at is an extremely long-term weekly chart with a Fibonacci retracement that begins at the end of 2015 when gold hit the bottom after climbing to an all-time record high of around 1920, and then was followed by a 5-year decline, which concluded at about $1,000 per ounce at the end of 2015. Following that, we saw this market in essence ascend to the new record top of 2088, and that took quite a number of years, roughly 5 years. So we had a 5-year decline, then we had a 5-year ascent to a new record high, and now we are once again in a long-term decline. So in terms of the time parameters based upon the most recent market rallies in gold as well as declines, we could certainly see this particular decline continue. And this decline began in August of last year when market forces took gold to its all-time record high at 2,088. Although for the most part, it has been sticking around 1,800 to 1,700 recently, we have to look at the big picture to see these series of tops in which we get lower highs and lower lows. However, we did hit a bottom back in March of this year, a double bottom, at approximately 1680, 1670. That is this double bottom here. The flash crash bottom, which matched that. We talked about this earlier this week. And then a long period of time in which this price point served as a support level as the market was moving up to the record high of last year. That being said, the important number is 1680 to 1670. That's the area that we need to see if it holds, finds support and pops back up, or if it continues to track lower. Most likely, looking at this chart, it seems as though there is an absolute potential for a further decline, at least until 1680. Beyond that, whether or not it bounces up at that point or continues downward will be the question, and that question will be determined by actions of the Federal Reserve. But considering that the Federal Reserve will begin to taper and then normalize interest rates from here up until approximately 2024 or 2025. And we know that that action has the potential to put bearish or downward pressure on gold. It is likely, all things being equal, that we will see a multi-year decline, as we have seen on the occasions that we just spoke about. It is for that reason that the short blips in the market in which they move back up or down are not as important as looking at the big picture and the overall cycle that we have seen gold trade to since the peak at mid-2011, which was followed by a multi-year decline from the middle of 2011 until the end of 2015. The rally from 2015 up to the new record high, which occurred in August of last year. So what insight can we glean with this multi-year, extremely long-term chart? I think the most important lesson is that the Federal Reserve initiated quantitative easing back in 2009 to stave off the recession caused by the banking crisis. As they unwound their extraordinary accommodative monetary policy, we saw a multi-year decline. From there, we go into 2016. And it was really in March of 2020 when the pandemic hit. You can see the effect on gold pricing, which moved in essence parabolic to the record high. That means that as the Federal Reserve begins to normalize rate, taper their asset purchases, we could easily see another multi-year decline through 2022, 23, and maybe up to 2024. This has been Gary Wagner, wishing you as always good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.